Hi,
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 everyone. I'm Monica Young. I'm the broker of Just Global Inc. and also the host of the Global Real Estate Investor Club. We are very pleased to invite Mr. Philip Guan to be our guest speaker today. Prior to setting up his practice as an accountant in 2002, Philip had worked in Arthur Andersen, which is one of the big national firm, the Big Five. And he has accumulated a wide range of experience by working closely with the partner. Besides, he obtained his accounting education in San Francisco State U and got his master's degree of taxation at Golden Gate University. Let us give a very big welcome to Philip. Hi, Philip. How are you?
hi, Monica. How are you? So, hi, everybody. Welcome to our presentation. And today, I actually comes out with those topics because a lot of people keep asking me all those live events when happens, what is going to happen. So I would like to summarize a little bit of myself, and this is my office, okay? And then, so we can keep next to the next PowerPoint presentation. So that way, so this is my family. I have my wife in the middle, and I have twin daughter. The one where the red is the dentist, and the one where the black is my partner in the CPA firms. So you probably surprises because we actually grand opening our CPA firm in the 10th anniversary of our marriage. So, okay, let's keep going. Now, the very first thing a lot of people asking is the retirement. So, and there's two ways for us to save money for our retirement. The very first one is use a P-tax money like 401k, IRA. When you make the contribution to this kind of a P-tax programs, first, you're going to get the tax deduction in the year of contributions. For example, in your W-2, you will see, let's say, if you have been contribute 20K per se. Let's say you make 120K before contribution. But if you contribute 20K, so those 20K will not be taxed in the year of contribution. So you will see in box 1 of your W-2, instead of 120K, you will see 100K, which is you only tax in 100K for the income taxes. And so now, however, when you take the money out, the money, the principal and interest together, fully deductible, taxable. And that is the not that good side of the thing. As you can see, not only the principal, but also the interest. On the other hand, I'm going to show you the second way, which is the next slide. The next slide is going to show you how to use the post-tax money, which means the after-tax money, like Roth 401k, Roth IRA. When you make the contribution to this kind of program, in the year of contribution, you are not going to get the tax deduction. Well, at first you say, well, wait, no tax deduction? Is it good? Well, let's finish. When you actually distribute the money, let's say, for example, you put the money, for example, you put 100K into this program, and let's say make it double, become 200K. So, but if you, in this situation, the whole 200K, when you take money out, it's tax-free. So that is good. Where the way number one, P-taxes, you put the 100K deducted. And when this 100K in the 401k or IRA become 200K, so the principal and interest altogether will become taxable. In another word, the gain is taxable for the pre-tax. The gain is not taxable for the post-tax. So now, maybe most people ask these questions. We go to the next slide. So which one is better? Should I go pre-tax or after taxes? In general, the post-tax way, like Roth IRA, is more tax benefit because in this way, the principal and interest both are tax-free. In other words, in this situation, the gain is free of taxes in Roth. So, of course, somebody will say, well, right now, I want to get a tax deduction. And then, but I also want to enjoy someday in the future, I could be able to enjoy the Roth. So there's a way you can do it. Let's say you have 401k and then you change a job and you can roll it over to regular IRA at first. And second, when in the right timing, for example, maybe in a year, you switch job, you maybe have some time off, your income is low, and you might consider to want to roll it over from originally IRA, become a Roth IRA. Of course, in a year of conversion, they become taxable. And then now you successfully change this whole thing from the moment after conversion, the gain no longer taxable. That's a good thing. Isn't it? Do you mind give me some water? Now, let's go to the next slide. Now we talk about the long-term care. So first of all, what is long-term care? So when you have 2 out of 6 event that you won't be able to do it, for example, walking, eating, bathing, restroom. So on the way, go to restroom, and also you've been using a restroom. So normal 6 event, you cannot perform 2. That you will go to in the long-term care. When you're in long-term care, you need somebody who take care of yourself. Like not long ago, my 94 years old mother-in-law who need long-term care. We need to hire a caregiver 24/7 with her. It's very expensive. So how to fund the long-term care? Well, you do nothing. So you're gonna save money. It's after-tax money, and then you make money. You, let's say, put the money in CD, and the gain each and every time need to pay tax, or if you put it in a stock or anything. But doing this way, you use the after-tax money to pay out. But there's a better way for you to fund a long-term care. The law will allow you one very special thing. There's only one tax law allow you that where you make contribution is tax deduction. The money taken out is also tax-free. So that is long-term care. The long-term care, short for LTC, excuse me, LTC, long-term care. Right. So the long-term care premium is tax deductible in Schedule A. And the long-term care benefit is tax-free. Now, where normally the life insurance, the premium is not tax deductible, but only the death benefit is tax-free. So let's go to next slide. There are 2 ways of a long-term care solutions. One is stand-alone long-term care. So now where there's no cash value in this kind of program. So it's just a pure long-term care. So in this situation, 100% of premium of the standalone long-term care is tax deductible. Now, the second way is you have a long-term care rider with the life insurance. You actually going to receive a 1099-R like larger. And in the box 6, there is a W. That stands for you take the money out, distribute it out on the yearly basis. You first pay the insurance company premium with life insurance, long-term care, as well as the saving, so all together in. And then the life insurance company take portion of the money to pay for the long-term care rider. So you will get the 1099-R and with the code W. That full amount is tax deductible for your Schedule A. And both way of benefit, when you get into long-term care, you get the long-term care, it's tax-free. All right. So let's go to the next slide. The third scenario. What if, unfortunately, sometimes we get disability or accident? There are two kinds of disability or accident insurance. The very first kind is the government offer. Like in state of California, you normally get to EDD to apply. So most of the EDD disability benefit is tax-free, but with some exceptions. So what is the exception? Well, normally life is easy. If it is taxable, they normally issue you a form called 1099-G. And in that 1099-G, they're going to be, you need to be put it in your 1040. Now, if you don't receive a 1099-G, in most cases are tax-free, or you need to bring your cases to your CPA to ask for it. Or another way, you can go on the IRS website, you create a username and password and get into your transcript to see if you have a 1099-G in your IRS transcript for that year. So that is a reverse way to find, and that is taxable. The second way of the disability insurance is you purchase from the normal insurance company, not from the government. But doing this way, obviously, you pay for yourself. In this kind, most of the benefits are tax-free. So let's go for the next slide. Now, when is the best time to apply for it? Well, here's the unfortunate part. When you are disability or when you actually accident, you are not able to get apply for it. So therefore, when you're well, you protect it. So you need to apply for it. I hope everybody get well, protect yourself. Okay, this is outside of the scope of my CPA, but I just my suggestion. Okay, so I wish everybody well. So let's go for next slide. Now, at the fourth scenario, is you move yourself from US to other country. So how the tax works? Well, if you're a US citizen or green card holder, you are still responsible to file US tax, even though you are working away from the US, which means you work outside of US border. For example, you go to Hong Kong to work, and you go to mainland China to work, or you go anywhere, even they just go across the border to go to Canada. So now there are two ways you can be tax saving. The first one is called foreign tax foreign income exclusion. The foreign income exclusion to give you, for example, in 2024, there's 126,500 per person that is excluded from the US dollars. Now, what if I make 200K? Well, the difference between 200K minus 126 and 500 is taxable. Now, the second way is the foreign tax credit. So you report the full amount, for example, in this situation is 200K as an income in the US tax return 1040. And then, well, obvious, you don't have a W-2. So there is a foreign income reporting portion. You actually can report it in. So now you're going to find everything like the US normal income, and then it comes out with the X amount of tax liability. And then you're going to ask me, so why I just go to report all? Why don't I take the 126K and 500 as an exclusion? Well, there's another way. It's called foreign tax credit in 1116 form. So now, if you pay the income tax to foreign country, now you can use the full amount of that foreign income tax credit and report in 1116 tax form, and as dollar to dollar to your 1040. For example, just there's a country charge, let's say charge you 45%. So now 45% of 200K, that's 90K tax credit will be get it into a tax form, and well, depends your tax bracket of you in the US. Maybe I'm just talking about the federal tax. I'm not talking about the state tax. So you may not be pay a 45% tax bracket. So therefore, in this situation, you, after the foreign income tax credit, you may even gain something. So now go to next slide, and the common question is, which way I should go? Should I go foreign income exclusion or foreign tax credit? Well, the best way is you should compare two ways. See which is the most tax advantage way, which means you end up legally pay less taxes. The law does not require you to pay $1 more. The law requires you just fulfill the law and doing everything legally and pay the least tax liability. So now, in here, normally, if the foreign income tax rate is higher than US tax rate for your current situation, you take the credit instead of exclusion. And the second situation, if your foreign income after you convert it to US dollar is high, like for example, 500K to $1 million, even more, because the fact the exclusion is only 126K 500, the rest of the money you need to pay tax into it. But in this situation, the full 500K or million income, whatever tax you pay it to the foreign country, will be 100% offset in the income tax. So in this situation, the foreign tax credit is more tax benefit for you. It makes sense, isn't it? Now let's go to the next subject. How about when you selling or buying a home? Well, that's a two scenario. Normally, when you buying something, Buying a home, similar like buying a stock, no tax. What I is going to be looking for you is when you're selling something, like when you sell a stock, when you sell a house, then you may have a tax liability. When I say may, it's because there is some tax-free capital gain. For example, in the first scenario, if you show your primary residence, where you own and use that primary residence for more than 2 years. What is called more than 2 years? At least 2 years and 1 day. More than 2 years is not exactly 2 years. Exactly 2 years doesn't qualify. It's funny, the law says so. So each person on the title and the use for it have a 250K. Now, what if the more than 250K? They're going to report in Schedule D. In that reporting, there is an exclusion portion of it that will be excluded. Now, those will enjoy the capital gain special lower tax rate. Now, in the situation is if two people who marry in the state of California, where the house is before marriage and one spouse owns it, and then the other spouses move it, and a lot of people will add the spouse name after they marry, and some people don't. Now, in this IRS tax law, it's more general. It's actually in the state of California in a community property, unless you state this property as a separate property, and you have to now when you originally have your title under yourself, and after you get married, you don't do anything changes, and that is not necessarily stay as a separate property. A separate property you have to go to the county to write a piece of paper. Well, this one, I'm a married person, and this is your separate property, and you have to have that, and you have your spouse who could claim you, and then you're going to put it in a title, unless you do so. If not, even though your name is not on the title, and you still, for this tax code purpose, only for this tax code purpose, and you still deem as you own it, which is cool. A husband and wife own these houses before marriage and did not sign that piece of paper, say this is my husband or wife's separate property, and then after both live there for more than 2 years, and as a primary resident, each have 250K. If somebody at this moment say, oh, I forget, I only take whoever own it. If that happened in the past 3 years, you can go back to amend it. But if more than 3 years after you file, unfortunately, the law will not allow you. Now let's go to the second scenario. Now, if you show a house is a rental property, well, there is called depreciation recapture. So what is depreciation recapture? Well, first of all, the house for the tax purpose comes up with there's a land and there's a building. The land is not depreciable, and the building is depreciable. For example, if you buy a house of 500K, for E to say the building is 275,000. Why I say 275? Well, because if the residential property is divided by 27.5 years, so make life easy, 10K per year depreciation. If you own this rental property and rent it out for 10 years, so 10 times 10 is 100K. 10K times 10 years is 100K. So accumulated depreciation before the moment you sold the houses is 100K. Now this 100K, you enjoy it over the past 10 years, get tax deduction as an ordinary deduction in your Schedule E. Well, when you sold it, let's say for $1 million. So in the most people mind is, well, $1 million minus 500K. Well, how much can I get? 500K. So in the primary residence, it happened like that. But in the rental property, no, you got to plus another 100K depreciation recapture, that's 600K. Not only that, this 100K depreciation recapture is going to tax as your marginal tax rate. What's the marginal tax rate? It's the highest personal tax rate in your cases on your total income at that moment. So the less of the 500K will be capital gain. Now, let's go to the next slide. What if I do not want to pay tax legally, and when you sell a rental property or investment property? Now, be careful when I say not only rental property, but investment property. So 3 kinds of houses. Resident to yourself. Inside resident, you have primary residence, you can second home. And the second home, you enjoy the property tax and mortgage interest tax deduction, but you won't enjoy up to 250K tax-free. Now, when you go to the rental property and investment property, rental property, you own it, you rent it to other people, use it. Investment property is you buy it, you don't use it yourself, and you do not rent it out, and you flip it. And the flip may be with or without improvement. So in this situation, you can use 1031 exchanges. What is 1031 exchanges? 1031 is in the Internal Revenue Code, the tax law, 1031 section. It will give you a tax deferred treatment. Now, tax deferred in the situation where I just mentioned with a 600K, the example I just gave it to you again. If you don't want to pay tax in a year or so, and you have to be, before you sold, you have to tell the agent and contact the 1031 exchanges company and structure this show as a 1031 exchanges. So all the money show cannot be getting into the seller's hand and go to the exchange company. And then the exchange company is going to transfer this money directly to when you purchase a new property. Now, you should not get any money to your hand, as well as you should not use those money to pay something, otherwise you normally pay for it. And there's a nice name, but not the coolest tax treatment. It's called BOOT. It's a funny name, BOOT. What is BOOT? It's a taxable portion amount that you need to pay tax into it inside of 1031 exchanges. So, for example, if you inside this normal exchanges, if you don't take a penny out, you have no BOOT. If you don't, let's say, the property tax, you normally should have been go ahead to pay it by yourself, not from the exchanges pay for it. But you use it, the exchange money, the money when you show it, yeah, and you go ahead to pay it, the property tax, that will treat it as a BOOT. Or if you do a fix-up, a big fix-up, and you do not pay those fix-up by yourself, and you use the money from the like-kind exchanges and you sold the property, and through the escrow you pay it out, that is a BOOT. The problem of the BOOT, not only taxable, but also zero cost basis. Because all the deferred, if you take 100K out, 100K it's not proportionally with the cost basis. 100K as a book, as a taxable. So therefore, is law possible? You should avoid the book. Okay, so that is very important. Okay, so let's go to next slide. I'm sorry, we are going to discuss something we do not want to talk about, which is the death of the spouse. When that happens, for the tax purpose, you have a few things need to be done. In the year of death, first, you can still file the tax return as like normal year, the 1040. So in the year, let's say if somebody passed away in the year of 2024, when you in the early 2025 file tax return, you still can together to file tax return in 1040. But with one exception, you need to be name it when this person passed away. When you do so, in a page 1 of 1040 on the top, there be one sentence is say when, who, and when passed away in what day. And for income tax purpose, the standard deduction or itemized deduction, they will still fulfill it in the year of that. The second thing you need to do is you may need to do estate tax. The third thing you may need, that estate tax is 706. When somebody passes away, estate tax is 706. When somebody in their lifetime to do a lifetime gift is 709. Now, you may also need to file trust tax return if you may create a trust upon your death. And those assets will go from your personal to your trust according to your trust instruction. So it depends on your situations. So now let's go to the next slide. Here is some common mistake when somebody have a spouse pass away in the state of California. We are like a community property state. This does not apply for some state who's not community property. So some people forget to step up cost basis for the rental property, for the stock that you own it, haven't sold yet. For the ownership of a company, the stock is for you to own a property company. When some private company that you have, so what you need to do is you need to do appraisal for all the above on the day of that, or you choose the opportunity valuation day. So they are consistent. If you do so, and you'll be appraisal on those days. And the 706 will be the same thing. I am going to answer questions along after I finish the presentation. And everybody, we are going to please hold your questions, and then I will answer all together. Thank you very much. Now, the second mistake, the first mistake is you totally forget to step up some of the things. The most common thing is you forget about the stock or some company, especially some private company. So now you need to hire appraisal, a business appraisal, to appraise your private owned company. Now, and the second one is because one spouse passed away, the surviving spouse, I said, well, I still own half of it. So I just step up half. That's common sense, but that's wrong. For the state of California, the surviving spouse is enjoy 100% step up. Yes, it's 100% step up. That means the surviving spouse share is also step up. So it's quite tax benefit. If you have a rental property, you bought it long time ago, even you have been fully depreciated. And in a normal year before pass a spouse, that fully depreciated rental property is no longer a depreciation. But when the step up happen, you will create a huge depreciation and it's deductible. Now, the use law have one thing very careful. When you go to depreciation, especially rental property, there's a law called say allow and allowable. If the law allow you to take the depreciation, if you don't take it, the IRS will going to deem you as you take it. When you sold the property, you have to recap it. For example, the law allow you to take 10K for 10 years, 100K in total. If you did not do it, when the year you sold the houses, you still have to recap 100K depreciation. Yes, it's not very fair, but that's the law. So is there a way you can change it? Normal amendment is only for 3 years up to. There is a legal way you do it. It's called change accounting method. You can do all these years. So now, let's go for the next slide. When you go to face a legal separation or the divorce, the tax law use the last day of the year, which means December 31st, to determine if you're single or head of household or married. For example, if we file 2024 tax return, as of December 31st, 2024, if you are legally married, you are married. If you're legally divorced, the court have been issue you the divorce, so you are divorced, which means you can file as single or head of household. Now, here's one thing. If somebody still legally married, can they file single or of head household? Yes, in one situation. If they live separately for the whole year. So that include if they have conflict, they decide to live separate, or they have no conflict, they just because for the job purpose, the two people work in a separate city. So again, I'm going to answer all the questions at the end, okay? And I appreciate you. So now let's go to the next slide. So when you are using a married file separate, what is the disadvantage? Well, unlike single and head of household, when you use a married file separate, especially with kids, you are losing a chance to get the earned income credit and some other credits. So let's go for next slide. When somebody who newly get married, so now we were just talking about divorce. Now it go to opposite. When you first, and then what is some tax implications? So now, well, first, congratulations, you get married. But when you get married, let's say in the year 2024, you get married. Since you are married, so you only have two choices. If you're using married, you have two choices: married file jointly and married file separate. Or if you legally married but you live separately in the whole year, you are okay to use either single or head of household if you have kids. So now, some people will have more tax advantage in one way or the other, depends on case by cases. So you need to, the best way is do comparison, but you need to be also consistently do it. And the law said, when you do file, let's say marry file separately, you have to be consistently do things, but you also need to show you have a good intention. Okay. Now, when somebody get married, let's say before married, if both of you, husband and wife, own a houses, a primary home. But if one person did not have that live it for more than 2 years, so you probably want to be stay in that houses so that you have 2 years or more, so you can enjoy the whole thing, right? Okay, now go to the next slide. My presentation, I'm finished, but I'm ready to answer your question. I can answer one at a time for question. Monica, how do you want to?
Yes, Philip, thank you very much for all this good information. It's really enlightening. I do have a couple of questions from the attendees. One of the questions from Ellen. She asked if she stayed in her primary residence for 5 years and then converted into a rental for 1 year. So when she does the 1031 exchange, can she still get that 250K tax deduction? And also how, so that the gain in the rental is lower for the future basis?
Okay, so she lived there for 5 years as a primary resident. Am I right?
5 years.
And then rent out the 6 years.
Yeah.
Now, and she show at the 6 after that. So now, here's cases. On the day when you show, you use your hand, you go back to look back for 5 years. Let's say of today. Today is September 28, 2024, right? So now 23, 2023, 2020, that's the first year, 22, 21. So in her situation, she does qualify. She does qualify proportionally. So first of all, when you in this 5 year have 2 years or more as primary resident, which in her cases she does. Okay, she have 4 years. So therefore, she qualify. She qualify doesn't mean she get a full 250K. And then in this situation, it's 1 hour 6 is rental. 5 hour 6 is primary, right? So in this situation, out of this, the 1 hour 6 is rental is taxable. It's taxable. And then the 5 hour 6 is tax-free up to 250K. So now in this scenario, it's going to be happen. Let's say for the 500K as a print, 500K is the original, and then $1 million is a selling prices. The gain is 500K. Now, in this situation, if the couple own this property, but it looks like, wow, 500K, I get rid of everything. No, it's this 500K, 1/6 of it is still taxable. It's not much, 1/6. So those 1/6 of that taxable could do 1031 changes, to answer your question. The less of the 5/6 of it is all tax-free. Now, in another situation, it's from 500K to 1.5K. Now the gain is 1 million. Outside this 1 million, 1/6 of it is belong to rental, So those amount could be due 1031 exchanges. Now, another 1/6 of that 1 million. Besides that is 5/6 of that 1 million. Now, this you get into the situation 5/6 of 1 million, you minus of the 500K, there's another portion, those person need to be paid income tax, right? So those are also okay to do 1031 exchanges. So the sum of the rental portion of it, as well as the excess portion of the 1031 exchanges, it will be qualified to 1031 exchanges. But you got to be structured very careful, and also you instruct the exchange company do so. You won't touch all those money to your hand.
Got
Ellen,
it.
am I answer your question?
Okay. So
Okay.
I would strongly recommend Ellen to really contact Philip, document the case, and also when you're ready to do 1031, talk to the CPA first to make sure that, what is your gain, how much you can keep, and all this. Yeah. So I have a couple other questions from Becky. So some of them are related. So let me read it to you. So regarding the step up, let's talk about the rental property or, the primary as well. So, the step up, is it both for the federal and the state? And also, yeah, the first spouse passed away, then like there's a full step up for, the remaining spouse. But then if the second passed away, then there would be also second step up for the heir. Does it sound right?
Yeah, we're talking about when, let's say, when the husband and wife, let's say when the husband passed away. So 100% of the things will step up as a fair market value for both the husband and the wife share. That is true. So how about when the wife pass away? Would that be a second step up? Yeah, the law allows to do so. Yes.
Yes, and it applies to both the primary and also rental property.
Correct.
So the step up, also the saving of the taxes would apply to both federal and the state.
Correct.
Okay, let me have a follow-up question because I'm in real estate. So it's very important that depends the point, especially for properties, on how they hold their vesting. Being that California is a community property state, so we always have lawyers advise my clients to hold it under community property with right of survivorship versus, joint tenants with right of survivorship. So does it matter to you as like an accountant?
Well, as for the step up purpose, the most important thing is community property with right of survivorship.
Yeah, so yeah, we do encourage, everybody, if you're not putting in a trust, consider, put it in the community property with right of survivorship.
For answer this question, for this income tax, for you to take advantage of this full step up basis, yes, that is.
Yes, totally agree. So regarding stock and also 401k and IRA, the stocks, do we have to step up?
Well, yes, the step up is a good deal because so you need to ask let's say if you have let's say child swap, you ask a child swap who do a step up determination. They will issue you, they use their letterhead, they issue you a step up basis with the list of the things. They may charge you a little fee, but that's well worth it.
Yes. So for IRA and 401k, do we put it in living trust, or actually there would be designated beneficiary when we have that set up?
It's a personal choices. And I saw in my practice, I saw people can have either way to do so. They could,
Yes.
but in either way, they will enjoy the step up. Now,
Got
the
it.
law allow them step up, but it's not automatically. So all the US tax law, they allow you to do so, and you have to go to apply for it. And it's not automatically.
Got it. So it's good to either consult your accountant on make sure that you have it properly set up, or contact, say, Charles Schwab or your actual financial agency to see if you have it properly set up.
Yeah.
And how about cryptocurrency?
Yeah, it's also anything, any asset that you own it in the state of California. If you are both, when somebody pass away, the death certificate, you're going to say which state, which county you are going to pass away into it. And those is important. And
I
yes,
see.
any asset.
Okay, including cryptos. Okay.
Yes. And
Then
even
yes.
include the asset you own outside US, inside and outside US.
Yeah.
The important thing
overseas
is
property and all this. Yes.
the most important thing is the determination is the person who passed away, and that in that life moment you are passed away as of resident of state of California, where is community property state. And those are the most important thing. And then any asset that both spouse own it, they are enjoy step-up basis. So therefore, it's in the US, you go to appraisal to do so. Now you're outside US, you need to get the similar appraisal to do so. And also, you probably have to do notary, so that way they're not English speaking. Okay.
Got it.
Mm-hmm.
I have some cases that my clients actually have the spouse pass away.
Mm-hmm.
And I actually suggested to contact you and try to find out about the step and basis, and they did.
Mm-hmm.
Thanks for your professional advice.
You're welcome.
And yeah, so like she does have the step up on the property, including primary and rental property. But on the other hand, she also received new property tax bill. Say if the property used to be only 500K in tax basis when they bought it. And so after she got a step up, because now like property appreciated a lot, now it's like over 3 million. So does it imply that once we have applied for the step up, then the chances like we'll get new property tax bill?
The US government, when we talk right now, when we talk is income tax. When we talk about a step-up basis for income tax, when we deal with IRS and as well as franchise tax for the income tax. Now, when you do the step-up basis, you are working with the IRS. And to the best of my knowledge, when you do the step-up basis, there is no process. You need to be working with the county.
But
so,
how did the county note that like there has been a request for the step-up basis?
When you told them.
Or if you do not inform them, it's not actually by law required to notify the counties.
Not that I know of, because
like, yeah,
not that I know of that they need to be a step-up basis process, unless there's a title. Well, there's a one thing. Yeah, there's a one thing, because when somebody pass away, now our conversation get into the conversation outside of what we just talking about step-up basis. And when we go talk the subject of property tax, actually get now, and this time the step up is not cool. It's the increase of step up. Increase. Now, let's not confuse it. Let's not confuse it. For income tax purpose, the step up cost basis is a good deal for the taxpayer because you're going to have a less capital gain, right?
Yes.
So when you show that, now when you have a step up for property tax, when you deal with county, you are going to pay more taxes. Now, when you the property proposition 19 before that, and then when somebody pass away, when between family, the property tax you can enjoy the original things, and then now is increased. There's nothing. So in fact, the property tax increasing, there's nothing to do with what we're talking about, the income tax step up basis. The two subject and two law govern. The US IRS, US tax law, income tax law governs the step up basis. And where each and every county, and if they are passing a law in each state, they will be governed by the state law, and then otherwise they will be a county property local tax law who do so. In this situation, yes, but the property tax will increase because you are going to go to county to change names.
Yeah. So another way to approach it, Philip, give us some advice. Say if my clients hold it in a trust, so you only have like maybe a change of trustee instead of like husband and wife's name that are community property with right survivorship. Do we need to notify the county because the trust name never changed? It's only the change of trustee.
No. This will go to beyond the scope of a CPA.
Yeah.
To answer your questions, to answer your question, those are standard. So I'm going to give you a standard answer.
Yes. Okay. I understand.
The standard answer is read the instruction of the county property tax assessor office instruction. Now, see if there is a fully disclosed requirement, and when the property is owned by a county, the trust. Okay, so if does, you fulfill requirement. If it not, the law does not require you. When the law require, you must fulfill. That's legal. But when the law does not require, and you don't have to, so you have to go to the instruction of that county, and if you have a question, and you should need to consult your lawyer and to see whether or not, because this is actually subject to law. Okay.
Yes, got it. Okay. So I'm glad you mentioned about, like, say, for people who move out of the country, how do they report tax and how to consider the tax impact. But some of my clients say they're looking at retiring in some of the income tax-free states, say Las Vegas, Nevada. So they're high income earner, and they would be retiring near future, say, for example, in 2 or 3 years. So when they have the RMD requirement being at age 72, so if they move to, say, Las Vegas and spend 181 days over there, are they subject to the state income tax in, when they live, more than 6 months and a day in Nevada for their RMD or other income? And also they have real estate income in California, rental income.
Now, IRS is cover all the income and expenses inside and outside US. There's no question about it. Now, each and every state, if the property inside the state law will cover the income coming from the property in that state, regardless the residency of your state. For example, if you are still Nevada resident, but you own a property in state of California, and that still subject to income tax for state of California, and vice versa. Now, and then the second part of it, the source, literally is looking for where the money originally come from. is it coming from state of California? So this rental property, so subject. Now, same thing as retirement. Same as retirement, as well as same as active income. If you make income, the active W-2 income in state of California, even though you're in the resident of state on the weather, and those parts of the California source of income still subject to California things. Now, and then you say, I'm retired. I used to work and live in state of California. Now I retire, I go to Nevada. And then you have to look in for your cases situation. And then you need to talk to a CPA, and the CPA will determine which portion is not subject to, and which portion is subject to. And the CPA had to do a determination to you.
Yeah, so advanced planning. So even maybe some of them, they would have pension, say from
Yes.
post office or the company. If that's from a California company, there might be chance still subject, right?
No, and then also, and it had to be, number one, you have to look in for the state law, state of California, like say for the speaking of state of California, you have to look in for franchise tax law, how the state law, income tax law is governed this subject. And as well as looking for other state law, how they govern. And then looking for two state law, how they govern, and then you have to comply with both state law. And then that will be the legal way to do so. Now, that could be the cases that where you don't need to be paid income tax for state of California, as well as Nevada, that they don't have state law in some cases. But some situations you need to be paid state of California income tax. Now, for short answer, unfortunately, there's no short answer. And so I give you an answer. It doesn't cover all. It should be in your. See, here is the phase of it. There's always a three-step process: tax planning, tax implementation, and tax review. And when you face the things that's outside of normal cases, you need to consult your CPA before happen, or at least immediate happen, if you have not been doing planning. The planning is the most important thing. Okay.
Yes, I totally agree. In fact, yeah, I always advise my client to try to contact the CPA, if not, like at least also sometimes the lawyer as well, you know, for their planning. So we have like the end of tax season, yeah, coming up quite soon. Like before we round up, because I don't see any other question, is there any specific tax advice or advice you would give us before end of the year? We should try to look for additional tax saving channels.
No, I always advise each and everybody, because the law only allow you to do amendment for 3 years, up to 3 years from the day of filing. It's a good practice. Always review the past 3 years tax return. You and all your CPA may miss something. And sometimes I have in my practice, I saw a client who filed tax by himself by TurboTax. When he sold a state of California rental property, and there is the withhold, and he forget to take it. And he also forget to tell me after he become my client, and then he told me at the 4th year. I told him, more likely you're not going to get it, even you file amended. And sure enough, he said, let me give a try. I gave a try. The franchise tax board write down. They said, yes, you do have that withholding. Unfortunately, it's over the time statute of limitation. You legally don't get it. That's a big chunk of money. So it's very important to have a habit, look back for 3 years. Now, and then the second thing is looking for the last year tax return. Normally, when you do tax return, you have a folder, and one side is where you gave the information to your CPA, and the other side is the CPA gave it to you. So you should have a habit for the new year, have a folder that we are 2024 in the same order. And then if you see something, 2023 have it, 2024 doesn't have it, you get the piece of paper, write down, oh, this doesn't apply. Or if you have something new, you write it down. So that way, your CPA more likely is not going to miss anything, and you are going to plan it. Now, especially, some people have 401k, health saving account, defined benefit. Those things must be done and fund before December 31st. So you need to, sometimes you need to consult with your financial professional and your CPA and a lawyer and all. So they get this whole thing happen on a timely basis.
Yes.
Oh, there's one more thing. Let's say you set up a corporation in the year of 2024. Let's say set up a corporation. You set up a corporation as a C corporation. And if you don't make any election, it's a C corporation. C corporation, state of California, federal pay 21%, state of California pay 8.85, which is almost 9. So add together, it's almost 30%. It's double taxation. But you can elect it as an S corporation. You can even go back to as a first day of this company. So that way you get tax advantage.
Yes.
So
that's helpful.
So is in this year, it changed a lot of new laws for the 2024. So, and then also, if somebody who newly immigrant in state of, to the US in 2024, and then you also need to file tax return, but also you need to report the foreign asset. In the first year, if you don't, even in the second year you report it, it's late. It's subject to 25% fair market value penalty. But if you do report, there's no tax for the foreign asset. It's only now. Oh, that's very important. When you immigrant from foreign country to the US, there's a similar situation when somebody's passed away. It's that step up basis. On the day of you get a green card, or on the day when you get into US, whichever is early. Okay, if you get into the US, you immigrant to get into the US, so that way you can use that day. And because if you own a property in a foreign country for a long time, and they maybe appreciate a lot, you need to hire appraisal to get the fair market value of that property. That will be a cost basis for you when you show the property in the futures, not your original posted prices. No, similarly, you need to do appraisal for all assets that where you own it all over the whole global, as well as you need to report it as a foreign asset. The foreign asset reporting, especially like the bank account, you not only report it in the 1040, but you also have a separate reporting. There's a 2 reporting requirement. Have 2 different due days. So
yes, I still have a few more questions. So I really appreciate, your time being very precious. But like, I think some of these questions, I think most other audience would be interested too. So one question is from Jane. How to apply for step up for real estate if someone passed away?
hire a professional. Your CPA is the first person to contact. And then your CPA should have been told you to contact a professional appraisal. And then if you have a normal asset like real estate, the appraisal can do so. And then if you own a business, and there will be a special business appraisal. And those have to be in official appraisal form. It's not just simple, let's say a real estate professional letter. If you just a simple professional in their personal opinion to do so, depends on who you face in audit. Some IRS auditor will not accept it as the evidence. So official appraisal.
Official appraisal of the property.
Yeah, go to your CPA, talk to your CPA, and first of all, those things. And then if you have the lawyer and who set it up trust for you, then you need to work with the lawyer and your CPA. Okay, so that way you're gonna get this whole thing works. Okay, and sometimes you need to work with your real estate professional, because that way you can easier to get the appraisal and all the things work.
Right. Usually I would get my clients connected with the people, professional like yourself and maybe lawyers who have a lot of experience in dealing with it. So another question, this is a question that have been asked a lot, you know, like about setting an LLC to own property, you know, like this attendee is asking, saying that is for tax saving purpose, you know, like I would like to hear from you how you look at it as a tax saving purpose, because most of the time LLC is set up being for asset protection. And of course, LLC does have a minimum tax of $800 per year in California. As far as you know, like LLC, does it need business license? And what would be the best way to set up LLC? And of course, usually we use lawyer.
Okay, that you asked me a lot of questions. Now, the first questions, okay. The LLC could set it up by a state. Okay, so the LLC could be, for example, you can set it up in state of California. You can get up Nevada. You can get up to other state. Okay, now the one thing, wherever the property located in the state, if you have not been set up that LLC in from that state, you also need to register as the outside state LLC. Now, so that's important. That is important. So you either incorporated in that state or register. Okay, so that is important, and you also need to have LLC requirement, and need normally on a yearly basis pay fee as well as filing requirements. And some states are very big deal about it, and there's a pretty huge penalty if you don't do so. Okay, so now, is there any tax benefit to have an LLC own versus your personal own? The straight answer is unfortunately no. Here's the straight answer. The straight answer, if you do, you are making something not legal. So, right? So yeah, because it's so the LLC, if in a general situation, for example, it's me and Monica, if either I own it by myself 100%, or let's say me and Monica own it together with the LLC in here, it's a pass-through and legal entity. So it literally is a pass-through it as a K1 to go to your personal. So they should be, for income tax purpose, should be the same. Same tax. Now, there's a second thing. Whether or not when you own an LLC, because the title is under ABC LLC in the county. Now, when somebody passes away, they're still owned by ABC LLC. Would that property tax increase or not? Depends on the county law govern. But that is outside of this discussion for the income tax. So short answer, there should not be a difference. There should not be a tax saving for LLC wholesale. Now, if you run a business, active business, not holding the property, if you're using the LLC and also choose this LLC for tax purpose as an S corporation, you need to do 2 steps. File this LLC as a corporation, and number 2, choose an S corporation. That you will have a tax saving. So
got it. So yeah, very, very comprehensive. Thank you. Okay, I think I would have this question as the last question, but it's quite a long question. Like this audience asked if the annuity 401k, they do have a step up, and if, say for example, the step up, the 401k owner has passed away, the heir have to pay tax. Say they inherit that. Does it have to be paid immediately or spread it out through a number of years? So what's your thought?
okay. When somebody pass away, the 401k will pay out to their beneficiary. So let's say that, so the beneficiary, now there's a two-way to do so. One is they immediately take all this money out, and then they will tax on the years of full distribution. Let's say 100K, if I take out all 100K. And the second is it goes to that person, but immediately roll it over to an IRA. And then there's no distribution. They will not be a tax on that year, and they will be taxed on the year of distributions. Depends. So therefore, you need your financial professional to work with you, to do a 10. See, property 1031 census is 1035 census. It's a tax law is 1035. Okay.
So same for the annuity.
Yes.
IRA's annuity. It could be
you have to be. This
Mhm.
had to be structured as a 1035 each changes.
Yes. Okay.
The money cannot be the money cannot be go to you and then you buy another annuity or anything. No, well, the law allow you within 60 days you do so, but it's kind of like you trick it a lot of times, the audit, yeah, and you have to do a lot of back and forward. You still can be good quality to do it, but it's best to working with a financial professional like Monica. I know you're not only the real estate, but you're also financial professional. And then you will know how the in and out to working together. Okay.
Yeah, yeah, that's very helpful because like when one has IRA or 1K or annuity, when you fill out an app, they usually would have your primary beneficiary as well as contingent beneficiary fill out. And then if, you know, the owner passed away, the beneficiary would be contacted, or you can call the customer care of the financial provider and then, you know, try to decide, like Philip said, yeah, whether you want to roll it over.
Yeah, and then also, yeah, when you roll it over, and sometimes immediate, you can roll it over to annuity, and then you maybe have an immediate income, so that they split out or over time.
Yeah, or partially, you know, like I think that can be discussed with the actual holder of the 401k and annuity, you know, the insurer, about like the best way to approach it.
That's true. So
yes,
so that they're doing this way so that you won't get hit by all of a sudden. Yeah, but
exactly.
It had to be structured right at the very beginning. It's very similar like when you sold a house, 1031 chances versus like so if you sold the houses and you get the money in your hand and then you buy another one, that is not 1031 chances. So the same thing as in here. But the luckily is the houses doesn't have the 60-day look back period for you to do it. If you are 1031 chances, 1031 chances is not. But in this annuity IRA, you do have a 60 days look back. But the first company who distribute the money, regardless what you do, if you just the money directly back to you, they will issue a 1090-R as taxable. Therefore, and then you have to do a lot of times you get an audit, and then you have to provide support. Yes, it was like that, and then we turn around to do a lower over, and then here is the sofa and so on. Right. Okay.
That's very good information, Philip. We really, really appreciate your time. I know you have a very busy tax season and you've done till like 4 a.m. to prepare this presentation for us. We really appreciate very much on this advice. And I hope that for all of you attended or who listened to this recording, if you have any question or any major event that you are going to approach or it happens on you, please talk to a good professional like Philip and try to get everything planned out.
That's good.
Thank you very much, everybody, for your time. And please have a very good rest of your weekend, Philip.
Thank you very much. I appreciate you. Bye.
Thank you, everyone. We'll send a recording early next week. Thank you. Bye-bye.
Bye.
Thank you.